Hello and welcome to this webinar from The Banker, Financing the Sustainable Transition, Measuring the Impact of Banks. As we all know, banks have a particularly important role to play in the global transition to a more sustainable economy. As the conduits to the capital needed for businesses and governments to invest in new technologies, infrastructure and ways of working, it will be vital for banking institutions to ensure sustainable finance is a core area of focus in the coming years, and for all institutions to increase their level of activity. This is why, together with sustainable economy and research and media organisation Corporate Knights, we have produced a new sustainable banking revenues ranking. The ranking analyses how much of their overall revenue banking institutions are deriving from sustainable lending, investments and underwriting, highlighting the scale of activity across the industry, which specific banks are leading the way, and those who may be lagging behind. You will be able to find a link to the ranking in the description for this video. In this webinar, I will be joined by colleagues from Corporate Knights who will talk to us about the ranking, how they came up with it, and the key findings. Later, I am also delighted that we will be joined by heads of sustainability and external relations from 3 banking institutions that prominently feature in our ranking. We will discuss and debate with them the challenges of both measuring and increasing their sustainable financing activities. Firstly, though, I am pleased to be joined by Toby Heaps, CEO of Corporate Knights, to give us an overview of the Sustainable Banking Revenues Ranking, as well as Matthew Malinsky, Research Manager at Corporate Knights. Thanks for joining us both. Toby, before we dive into details of the ranking, perhaps you can give us a really quick introduction to yourself and also to Corporate Knights as well.
I'm Toby Heaps, co-founder and CEO of Corporate Knights. And we started Corporate Knights 20 years ago with 2 core beliefs. One, the maxim of Peter Drucker, what gets measured gets managed. And 2, in order to solve our biggest problems, businesses must be part of the solution. And so we've been doing this for a little over 20 years now, trying to cut through the noise and find the signal by measuring the most important factors that relate to sustainability for both companies and financial institutions.
Great. And so what is the ranking and what is it measuring?
So most rankings that deal with banks and climate change focus on the negative. They focus on the extent to which banks are providing financing for fossil fuels. This ranking takes a much different approach. We're focusing on the extent to which banks are benefiting and poised to benefit from financing the solutions for a low carbon sustainable economy. Specifically, we're looking at the interest income, calculating the interest income derived from the outstanding loan book to sustainable activities is defined by the Corporate Knights Sustainable Economy Taxonomy that roughly lines up with the EU taxonomy, but goes a little bit more granular and a little bit broader. And we're also looking at the fees that are earned from the investment activities and the underwriting activities that are directed towards supporting the sustainable economy that banks take part in.
And why did you decide to create this ranking?
Well, what gets funded gets done. And if we're going to deliver on the Paris Agreement and solve for the climate crisis, banks are ground zero for providing the financing. The approximately 9 to 10 trillion US financing that will be required per year that McKinsey calculates for the Paris Agreement. And at the moment, there's a bit of a gap and a shortfall. And it's not entirely because projects are not bankable. There are many, probably trillions of dollars of bankable projects, but banks are getting their systems up to date and getting ready so that they can really unleash their full power and play their full role. And we want this ranking to help put a focus on that.
Some big numbers there, and you started to touch on this. So what impact are you hoping the ranking will have within the industry?
Well, immediately, one thing we discovered from this ranking is 2/3 of the leading banks in the world, because we were only looking at the leading banks, we're part of the Net Zero Bankers Alliance, are providing pretty scant information around the extent to which they're financing the transition to a low carbon sustainable world, even though they've signed up to the Task Force on Climate-related Financial Disclosures, which would seem to suggest that they're signed up to disclosing what they're doing there. And so we hope it has an immediate impact on improving disclosure. And the taxonomy that we put out, as well as what's out there with the EU and other great initiatives like the Climate Bonds Initiative, I think provide a good basis for that to be adopted and for us to see some fairly rapid improvements even in the course of 1 year. And then we really hope that it helps put the focus of senior bankers to realize the opportunity of being part of this massive capital and investment allocation to the sustainable economy. It's probably one of the largest investment stories of our lifetimes. We're looking at 9 to 10 trillion per year for multiple decades. And for banks to be part of that, they have to get the systems in place. And we hope that this focus, this barometer, can also be an impetus for that to happen. And we can see just from the top 4 banks in this year's league table, it's possible to have upwards of 20% or more of the overall activity of the bank exclusively focused on financing this low carbon sustainable transition, and still to be doing quite well.
Thanks, Toby. I think you're absolutely right that it is one of the most important investment stories of our lifetime. But thank you for that. I'm going to turn to Matthew now. Can you talk us through the key aspects of the methodology for the ranking?
Yeah, certainly. So as Toby touched on, the starting universe was the Net Zero Banking Alliance signatories. So that's a pool of 110 banks. Then we had a dual requirement that they also had to be signed up to the Task Force on Financial Disclosures, so the TCFD task force. So that arrived at a universe of 91 banks. So these banks were then assessed under the Corporate Knights Sustainable Economy taxonomy. And as Toby mentioned, it is closely aligned to the EU taxonomy, although we do have a bit more breadth and depth in terms of granularity and just what is quantifiable and accessible under sustainable definitions. So we were looking at the sustainable revenues generated by these banks in 2021. All of this was done through an initial assessment of public disclosures. So this includes annual reports, sustainability reports, responsible investing reports, green bond allocation, et cetera, et cetera. The findings were then presented to the banks, and they were given 3 weeks for a feedback period for them to review the findings of our analysis and supplement any data that we may have missed. So in the assessment of sustainable revenue for the 2021 sustainable revenue ratio is the figure that we were looking to quantify. We're looking at the revenues that were earned on interest from outstanding sustainable loans, revenue that was earned from the management of either third-party or general account sustainable investments, and revenue earned from the underwriting of sustainable bonds. So of these 91 banks that we did perform the assessment on, we were able to quantify a sustainable revenue ratio for 2021 for 60 of the banks. And then out of those 91 banks, we reached out to every single one. 14 of them responded to our request for data verification. So additionally, we were able to supplement a large amount of data through a partnership with the Climate Bonds Initiative. They provided us with underwriting volumes for many of the banks that were assessed. For full disclosure, the format in which they provide the underwriting data will list all of the banks that were involved in the underwriting and the total amount of the issuance. So in the case where there was multiple underwriters on a single bond, we would take the average amount split evenly between all of the banks. So that's a brief overview of the methodology for our approach to quantifying the sustainable revenue ratio, and ended up coming up with the ranking for these 60 banks.
Oh, that's great. Thank you for that overview. But let's get to the moment we've all been waiting for. What were the key findings and who came out at the top of the table?
Van City topped the list. They had a 2021 sustainable revenue ratio of 34.13%. This was followed by Spare Bank 1 at 23% and Amalgamated Bank at 19.4%. These are the only 3 banks that had a sustainable revenue ratio of over 10%. Looking at volumes, Intesa has the largest outstanding sustainable loan book with over $220 billion USD, followed by Commerce Bank at $130 billion USD. And when we are looking at exposure on the underwriting side of the business, Commerce Bank underwrote the largest volume of sustainable bonds in 2021 at a volume of 90 billion, which was followed by Credit Agricole at 67 billion. So some of the key takeaways were 47 of the banks that were assessed underwrote green, social, or sustainable bonds in the year. In regards to loan trend themes, we saw that 43 of the banks reported sustainable loans in 2021, total sustainable loans outstanding. 7 specifically disclosed loans to the renewable energy sector, while 7 reported loans for green mortgages. And we were able to identify 44 banks as having a reported line of either investment, loan, or underwriting that was strictly environmentally focused, while 7 of the banks had a strict social focus on one of those lines as well. In terms of other key takeaways, I think what we saw, there was quite a lack of availability of quantifiable investment data. That's not to say that it's not out there and it's not disclosed by the banks, but in terms of how we would be able to use it to come up with a revenue total from management of these sustainable investments, it was not broken down in a granular sense. So there were very few banks for which we were actually able to come up with a sustainable revenue total from their investment.
That's great. Just worth noting as well. So if in case for anyone that's not familiar with the institutions we mentioned at the outset there. So Vancity is a credit union that's based in Vancouver and serves that region. Sberbank is a Norwegian savings bank. An Amalgamated Bank is a union-owned bank in the US. And I think then you mentioned Commerce Bank and Intesa. So obviously Commerce Bank, large German bank, and Intesa, large Italian bank. And we're lucky, actually, we'll be joined by representatives from Vancity and also Sberbank later in this webinar. But to get back to the questions, Matthew, was there anything that came out in the research that surprised you at all?
One thing that really stuck out to us was actually that the level of sustainable bond underwriting activity was nearly on par with the loan book activity in the given year. So the revenue that was earned was nearly on par, and the total volumes, which was not what we had expected. We'd expected the loan book activity to be a significantly larger portion of the overall picture than the level of bond underwriting activity. Another pleasant takeaway as well was we saw a couple of emerging market banks in the top 20. Investec Group from South Africa ranked 7th overall. And then Banco Mercantil del Norte, which is a private bank in Mexico, ranked 15th. So it's nice to see some good representation across the board here and ranking pretty high up throughout the assessment, which was great. Just that there's been a growth in the green mortgage market. So seeing that 7 of these banks were reporting loans for green mortgages is definitely a trend that we want to see continuing on in the future.
No, and as you say, good to see that kind of widespread representation. And we're also pleased we will be joined by a representative from Investec as well for the next part of the webinar when we have our discussion. I guess just finally, what are your hopes for the future with this ranking? How do you expect or hope it will evolve in time?
Our hope is that this ranking is going to influence greater disclosure moving forward. The goal is to allow for a richer analysis year over year. We want to be able to provide a clear picture of how, because we know that these banks are leading the way. Like, these are supposed to be the leaders that signed up to the NZBA, signatories of the TCFD. We want to be able to clearly paint the picture of how these banks are funding the transition through their various methods of financing. So we're looking for a granular specific definition that are broken out by both themes and asset classes that can indicate to the general public exactly what level of contribution these banks are making to the overall funding of this transition that is so important.
That's great. Well, thanks, Toby and Matthew. Thanks, both of you. Some really useful insights there about the ranking. So as both Toby and Matthew mentioned, if the world is to hit key decarbonisation targets and also to create a more sustainable economy in a broader sense, banks will need to increase their levels of sustainable financing. And crucially, the level of sophistication of disclosure and reporting will also need to increase too. To debate and discuss how banking institutions can do both of those things, and also the challenges involved in doing that, I'm pleased to be joined by an expert panel from 3 financial institutions that feature prominently in our ranking. I'd like to welcome Caroline Bjerke, Head of Sustainability at Sberbank 1. Hi, Carolina.
Hi there.
We are also joined by Jonathan Fowley, Chief External Relations Officer at Vancity. Welcome, Jonathan.
Yeah, thank you very much. Good morning.
And also Tanya dos Santos, Global Head of Sustainability at Investec. Hello, Tanya. And Toby Heap, CEO at Corporate Knights, is also joining us for this discussion. Thanks, Toby, for staying with us for this. Before we dive into the discussion, though, Carolina, Jonathan and Tanya, I'm going to ask you all to give a brief introduction to yourselves and your role. So, Caroline, you first.
I'm Caroline Bakkahjerte. I'm Head of Sustainability at Sparebank 1 Østlandet, and we're the 4th largest savings bank in Norway. We're situated at the eastern part and capital part of Norway around Oslo, and what is called Innlandet, and we have 75% retail customers and the rest mainly SME customers.
Thanks, Carolina. And now you, Jonathan.
Vancity Credit Union is a member-owned financial cooperative in Vancouver, which is on the west coast of British Columbia, and also in the unceded traditional territories of the Coast Salish people. represented today by the Musqueam, Squamish, and Tsleil-Waututh nations. We were founded about 76 years ago and are a member cooperative serving 560,000 members with a total asset size of 33 billion assets and assets under administration. I oversee our impact areas, so sustainable finance, climate, indigenous banking, affordable housing, also our marketing, government relations, and communications functions here at Vancity.
Thanks. Tanya, can we have an introduction from you as well, please?
Hi, I'm the Global Head of Sustainability for the Investec Group. We are a dual listed specialist bank and wealth manager, listed both on the London Stock Exchange and the Johannesburg Stock Exchange. So we have a really interesting interplay between the developed and the developing world from a sustainability perspective.
That's great. Thanks, Tanya. Okay, well, let's get into it then. So I'll stay with you, Tanya, first. So can you tell us, what have you found to be some of the biggest challenges of reporting banking performance against sustainability objectives, particularly, sustainable levels of sustainable financing activity?
So actually, we've been very fortunate because Investec has been on this journey for many, many years. So our first sustainability report was actually written in 2002. So more than 20 years, and it was called Our Journey to Sustainability. And I know this because I wrote it. So we really have been on this journey for a good 20 odd years. And I think because we've been on this journey, we've slowly grown with it. And as the exposure and the disclosure has expanded, we were able to, it was just little incremental pieces. I think the challenge lies for companies that haven't done that, and they're now having to catch up. And we're seeing it with clients where they're going, well, where do I start? What is the most important? Is it SASB? Is it GRI? I don't know what to do. So I think now you're getting a flood of requirements, which is making it incredibly hard for people to decide, firstly, what to disclose, and then in terms of which reporting requirements. So for us, the next challenge is around more sustainable finance and impact, as opposed to the traditional ESG reporting requirements.
Jonathan, obviously you work for a very different institution to Investec, but does anything kind of resonate there, or are there other challenges?
Aside from having written ours 20 years ago, and we were in the business of it, I wasn't personally holding the pen, but everything Tanya says resonates. And I think the things I would add to it are twofold, and two really big challenges in our mind. The one is kind of systemic in nature, and the other is, I think, an emerging serious equity challenge. And the systemic one is really about standardization. And so how is the language that we're using and the numbers that we're reporting against and the frameworks that we're using stacking up against other jurisdictions? Canada, here we sit on a national advisory panel that's looking to define the taxonomy for sustainable finance in Canada, similar to some efforts that have happened overseas. But those are all going to differ and be different, and I think are going to create a very different framework that if we're not careful, I think we'll be using different standards, different language, and will get quite complex. The second, and I'll just talk about it briefly, is an equity challenge around how do we make sure that what we're measuring isn't at cross purposes. So what do I mean by that? Well, if we're just measuring emissions, we could easily get, not easily, but we could get to net zero by making some decisions that will significantly impact financial resilience, making it less affordable for folks who are not choosing sustainable options. So for us, we're trying to bend the metrics together and the measurement frameworks together to say, how are we making sure that we are creating a cleaner and fairer world and using metrics to support that journey?
And Carolina, from the Norwegian perspective, is there anything else you would add there, or again to some of those things that Jonathan was saying around making sure you're blending those metrics together? Is that something that's important on your side as well?
Yes, absolutely. What maybe differs a bit for us is that our customers are mainly SMEs and retail customers. So when it comes to the SMEs, we have like a 3-step ladder to work on the sustainability transition with them. Some sectors we're not financing at all, like oil and gas, fossil fuels, mining. And then we do a ESG assessment on all loans over 1 million NOK. And that is the assessment that we do is with questions or risks relevant to that particular sector. One of our largest sectors is agriculture. And of course, the challenges that they have in agriculture is different from commercial real estate. We try to make sure, like Johnson was saying, on all S and G issues. So also the social issues are different, of course, in the agricultural sectors than in commercial real estate. So we do an assessment, and then on top of that, we have green loans to help transition for those customers well, for all of our customers that want to do the transition.
Yeah, it's interesting. I'll turn to you now, Toby, actually, because it's funny, a couple of our speakers now have mentioned they've been in this kind of area for about 2 decades now. And I know that Corporate Knights has also been kind of looking at this area for about 2 decades as well. But from your perspective, I guess on the other side of this, that you're doing the analysis of the data that banks are putting out about their performance against sustainability targets and objectives. What are the biggest challenges from your perspective, as the person that's trying to make sense of the data that's being put out there?
In an ideal world, if we had our druthers, what would happen in terms of when we looked at the bank's annual audited financial statements is we'd see the specific exposures, outstanding exposures on the loan book to sustainable loans and on the investment book, whether third party or in-house. And we'd see the new additions that year to the sustainable loan book as well as the investment book. And then we'd see the underwriting activity to sustainable companies or sustainable activities. And we'd see that all clearly. And we'd also see, in addition to that, we'd see what definitions were being used, whether it was in line with the EU taxonomy or the Corporate Knights taxonomy or the climate bonds taxonomy. And we wouldn't just have things like we have a $10 billion loan book for green buildings, but it would go into specifics about what qualifies as a green building. It wouldn't be a line by line every loan, but give a general picture. And in addition to that, what we would also see is instead of just exposures, we would also see the revenues earned from those financing activities, because ultimately that's an important metric for a business. Anecdotally, really interesting, one of the largest banks in Canada, a director told me, just in confidence, not to disclose what bank it is, they did this analysis themselves and they broke out their activities, in the power sector from sustainable versus, old. And what they found was that their sustainable loan book revenues were growing twice as fast as their overall loan book. And so I think this kind of disclosure could be incredibly powerful in terms of generating insights internally at financial institutions. And we have many of the leaders here with us today who are doing different parts of what I spoke about, but no financial institution in the world, including the leaders that are here today, is yet sort of doing it at that granular kind of level where you're getting the specific disclosures at an outstanding and at an annual rate, and also disclosing what the fees and revenues earned overall off those activities are.
Okay, and you've spoken there about what you'd like to see in terms of the reporting and some increased granularity there. The other topic we're talking about in this webinar is, obviously the reporting is an important part, but just actually increasing the levels of sustainable financing as well. So what actions would you like to see prioritized, on that side of things?
This is where it's really interesting, because banks are such an important institution in our society. They're really ground zero for what gets funded or what doesn't get funded. And if the proper systems are in place and the economics make sense and the projects are bankable, some really beautiful, great things could happen. We know about $9 to $10 trillion per year is required in order to finance and deliver on the Paris Agreement. We know that global banking assets are in the neighborhood of $180 trillion US dollars. So what we're looking at is something about 5% of the balance sheets being directed on an annual basis towards sustainable loans to help transition towards the Paris Agreement to deliver on that. What we have at the moment from this assessment we did of the leading banks in the world is something in the neighborhood of 1%. And so it would be great. What we'd love to see this measurement and exposure continue to progress. And if there's room for the average sort of exposure or in terms of annual loans being given to be 5% of the balance sheet for the average, then obviously the leaders, some of whom are here today, as we can see with Van City, you can have up to 34% of the balance sheet being directed toward these activities and still be growing and doing quite well.
So Tanya, I'll turn to you now. As you said at the beginning, this is not a new area by any stretch for Investec, and it's obviously one where you're continuing to evolve your approach. And Toby's outlined a number of areas from his perspective that he thinks would be key priorities. I mean, talk to me about what Investec's key priorities are in the coming period in terms of increasing sustainable finance activity.
And I think Toby raised some very important points there. And I wanted to quickly write down what those percentages were, because what I find with some of this reporting is, because it's not consistent, it's very hard to be able to compare yourself to peers. So, we did a very comprehensive Scope 3 climate finance report. I think it's one of the most extensive analysis that's been done for a bank of our type. It covers 68% of our loan book. But when we went to go and do our research on our peers, we could not find that type of information that Toby's talking about. So one, we didn't know how we stood. We didn't know what should we be disclosing. Is it just the absolute amount? Which ratios count? What's important? And it's per sector. Are we even using, the best practice methodologies? And I think a lot of our peers are holding back, waiting to see, what the recommendations are and what the peers are doing before they go out there. So we were pretty bold in just going for it, jumping head first, and we decided that we would learn from that experience, and that hopefully people like Toby will come back to us and say, well, preferably we'd like to see you disclosing X, Y, Z. So certainly that was a massive project over the past year to get to grips with those methodologies and those carbon emissions scenario analyses. Our project for this year is the sustainable finance, exactly as you're positioning it. Now we're a very small bank compared to some of our big international peers, where they've got teams of people, collecting this information. I've even been told they've got teams of scientists, environmental lawyers, etc. We don't have that, so we kind of have to rely on a lot of work together with our peers and learning from best practice. So sustainable finance for us, first thing was to put together that sustainable finance framework to understand very clearly those taxonomies that we mentioned in terms of the loan principles, the bond market, the social bond principles, etc. So we literally have all of those included. Our own sustainable development goals framework, so which are our strategic priorities from a sustainability perspective, and then how does that all link together? And then the hardest part is actually developing a system that flags that information, because everyone has different interpretations of what would classify, what is eligible, and what those impacts are, because really we want to be able to show how many emissions are saved, or how many people have access to water that previously didn't. Those things are still haven't been defined exactly. So yes, this is still for us a learning space. We are hoping, in the next year that we will be able to say, well, we have X% of our portfolio. And once again, I think we would do it on the basis that we did our climate report with full disclosure on transparency. Full disclosure on assumptions made, definitions used, etc.
Thanks, Tanya. Carolina, I'll turn to you. Tanya was talking about this still very much being an area, a learning phase, and figuring out of defining different metrics and what that means in different circumstances, etc. But it was interesting what she was saying about still going ahead and trying different things anyway. I'm just wondering, in a Sparebank context, does that kind of ring a bell with how you're approaching this and increasing your levels of activity around sustainable financing?
Absolutely, and both what Tanya was saying and what Toby was saying, because I get your challenge, Toby, totally. And we've actually taken some steps in that direction with our new KPIs, because we were just entering into a new strategic period. And in that, we try to be very, very concrete about the ambition for our green portfolio. So we are now measuring the amount of green assets we have in our lending portfolio, which is 16.9. And then we're very open about how we define it as green. Is it close to the taxonomy as we manage? We do not manage, because some of the criteria are not, it's not easily translated into Norwegian contexts. And some of the do no significant harm criteria are difficult to interpret, but 16.9, and we're aiming at 20.0 7.4 in 2025. So that's very concrete, and it's a concrete increase. And then we divided that into in mortgage real estate, we go from 17.5 to 20, in commercial real estate from 29.4 to 40, in transportation, etc., etc., etc. So that's maybe answering some of the challenges that you gave us, Toby. But being concrete about where are you and what is the definition of green? In this case, only green. We also have the sustainability, the rest of the sustainability agenda, of course, on the side. But in this case, just to have one example of the green, what is the proportion of green now, and how do we define it? And of course, we're going to tighten those criteria and getting them closer and closer to the EU taxonomy. And then what is ambition going forward? And that makes it easier also for us to have that in financial reporting for each quarter, and saying, this is ambition, and also having them divided into the sectors is important, because otherwise it's impossible for external readers to understand what does this consist of. And this is of course also tied to our our science-based target about how to reach net zero by 2050. So this is supposed to, increasing the green portfolio is supposed to reduce, or hopefully will reduce, the carbon emission in our scope 3 in our lending portfolio.
Yeah, thanks, Carolina. So, yeah, sounds like certainly some steps being done there. Jonathan, talk to me about the Van City's approach as well, and if you would like to respond to Toby's challenge, or just or you can tell me about some key priorities that you've been looking at.
And so much there from others on the panel. I think I'll start really with that number that Toby mentioned, around 30+% at Van City. That number is a measure called triple bottom line assets under administration that our folks here have developed, along with an organization called the Global Alliance for Banking on Values, and it has been refined over the time. And I think as we look to the future, I want to take a moment and reflect to the past. I mentioned that Van City's been doing this work for a number of years, well before I got here. Tanya held the pen and did the work on hers. I did not here, but the teams really saw the connection between, as Toby mentioned, the financial sector and our communities around us. We make decisions every day that decide whether or not people are going to get a loan or financing or funding to bring an idea to reality. And so what triple bottom line assets under administration is to say is really understand those decisions and how they're going to affect the world around us as we move into the future. So yeah, as we look to the future, to say, how do we keep that same pace of change and progress? And I think I would break it down into 3 areas. One is data. We really need to have a firm handle on the data. Right now, when it comes, I think particularly with climate data, it's highly estimated. When we're tracking emissions attributable to our loans, and we're working feverishly, I would say, not only to get a handle on our own data, but to work with governments, regulators, and other sources to really improve that data, so that we can see the connection between the loans we're making and the impact that we're having, whether it be positive, neutral, or negative. And the second is using that data. So it's one thing to say that we're financing sustainably. The second thing is, how are we enabling a transition and a change? And so using the data and the targets to say, how are we engaging directly with our members, with policymakers, with the economy, and growing differently, so that we're enabling a transition, so that we're not just reporting, but we're using that reporting towards better outcomes. And the third one is really broadening the work. And so adding, as I mentioned off the top, we're looking to develop, along with our partners at the UNEPFI, some metrics around financial resilience. So that intersection point is really captured, so that sustainable finance captures the E, the S, and the G, as Caroline so appropriately mentioned. And in Canada, we would add an I to that, which is Indigenous inclusion, financing, and impact as well.
Yeah, it's clear from your answers and the answers of both Tanya and Carolina as well. There's so much work going on, and it strikes me always in this conversation and in other conversations I have, this is not an area where any one person or any one institution has got all the answers, And I'm interested, the panel's views. Is this an area where industry should be taking a collaborative approach? And is that already happening, actually? Toby, give me your perspective on that.
In order for banks to continue to thrive, societies need to continue to thrive. No bank can succeed in a society that fails. And we're at a moment over the next couple of decades, really starting now, few years ago to really be putting the pedal to the metal and really speeding up the flows of finance to bankable projects. If a project doesn't make sense, it's not going to get financed, but there are many, many projects that make sense. And banks can help bring those projects into reality, as Jonathan said. And I think if what Tanya said in terms of, the name of the game here is to sort of rapidly improve disclosure and exposure. And I think that's what we're focused on. And there's a big opportunity, I think, for banks to really lead here, because they're ground zero for the financing, and they have the direct ties to the communities, the businesses, the countries, the people who are going to be who want to go and implement sustainable solutions, and they're looking for the financing. So I think banks coming together, working together on this, it's an existential issue for our civilization, certainly for the banking sector. So I think there's a lot of upside to that, especially around getting the comparable metrics. And we don't need to wait for perfect. There are the EU taxonomy, there are other taxonomies that are ready to go. The International Accounting Standards Board will normalize this over the course of the decade. But I think the name of the game is to sort of is speed, and it's okay to have some revisions as we go down. We don't have to get everything perfect right away.
Tanya, your view on this, the importance of that collaborative approach between banks on these issues.
We actually have a very strong view on this. It is one of our strategic priorities as part of our net zero strategy, and particularly around the just transition is our ability to advocate and work with our peers for a better solution. So, in South Africa, we have something called the Bankers Association, where the big banks come together. We have been doing this since 2011 and discussing sustainable finance. It's called the Sustainable Finance Committee. So we discuss this as a committee. We would look at it from both perspectives. We engage regularly as a committee with National Treasury, with our regulator. In fact, we worked with them on the sustainable taxonomy for the country. So it's very much a collaborative space. As I said, we're not big, we don't have teams of people, so we desperately want to work with other banks and peers across the world to learn from them. So we've joined PCAF, Partnership for Carbon Accounting Financials, and we just have such immensely valuable discussions with those peers in the UK, in South Africa. So it's been really, really valuable. And for me, that is a key. This is more of a collaborative space than it is a competitive space. Of course, it's going to be a competitive space because, we're still in it for the business. But there's so many immense opportunities around the financing of large-scale projects that we can do together as a banking sector or as a financial institution. So, no, for us, advocacy and learning from peers is a massive part of our strategy.
Yeah, and Jonathan, how about your views? I know as well as another smaller institution, it's interesting. A lot of the focus on this agenda is on, some of the bigger players, but smaller institutions are often able to, perhaps innovate or take different approaches to these issues that might not be open to larger banks. I'm just wondering what role you think an organisation such as yours can play in that kind of collaborative working space with the other banks.
I think we do have a responsibility to act in this space, but also an opportunity to push at the margins of where we can be. And what do I mean by that? I mean, I think right now, like Tanya suggested, we are collaborating with government in a number of different areas, but not in the ones that are probably folks would think a financial institution would get most involved in. So what do I mean by that? Today, after I get off this call, I will be going and working with the team on the final pieces on our submission to government around Canada's clean building strategy, getting into the weeds on building codes, on electrification plans, on the various ways that we can move our built environment towards a net zero future. And that's not a traditional space for a financial institution to be getting deep into policy. So I think these types of collaborations, both with industry peers, with regulators, with central bankers, with governments, with members, with customers, is essential. The one flag I would make, though, is that oftentimes when we collaborate, we seek consensus, and I think we need to move forward together And I think we need to take some purposeful risks as well. And sometimes that takes folks, and we see that as our role here at Van City, to kind of move a little ahead of the crowd and just determine what is possible in that space, and then openly share what we learn with others who are interested in willing. So I think there's a role there for folks to pursue possible solutions, and then a responsibility and accountability to share those findings in, yes, a competitive space, but also one where we all have a responsibility, we think, to help create a better path to net zero.
Yeah, and Carolina, Jonathan raised some interesting points there around the importance of, that collaborative working and reaching consensus, but also being able to push forward and make progress. Your views on that. How to work collaboratively, but also to push forward and make that progress that you need to see happening in this area.
Well, I can only agree with the others, and also I totally agree with the point of being small and having to collaborate. We're using the Unify initiatives a lot, so both PRB and the Collective Commitment to Climate Action, Net Zero Banking Alliance, PCAP, etc. But also was what Jonathan was saying about collaborating with the sectors. Like we have a large agricultural sector, and our goals in the agricultural for our agricultural customers is supporting the transition plan that sector has set for themselves, and that is, like Jonathan was saying, also pushing them and giving the incentives that we can give as a bank with loan products and interest rates and etc. for projects that are delivering on that transition plan that the agricultural sector in Norway has set themselves. So that's a concrete example of collaborating with one of with the industry that we absolutely need to be able to have the transition in our portfolio as we want.
Well, thanks Carolina for that, and thanks all four of you for that lively discussion. Unfortunately, we are going to have to leave it there, although there were plenty more questions and areas we could have dived into there. That's all we have time for this webinar. If you'd like to look at the full results of our ranking, you can find the details in the description for this video. I'd also like to thank Corporate Knights for their work on the Sustainable Banking Revenues ranking. But that's it. Thank you for watching, and goodbye to our panelists as well.